Hi everyone. Uh, Let me know if there was any technical problems with the new stream. I'm not sure why, but it shows me that I've kind of been in that stream already. So let me know if there is any technical difficulty with it. Let's see what we have for today. In the module 3 folder here, let me share the link. In the module 3 folder here, I did some excerpts. I provided a link to the guidance. Here is a link to the guidance to which I will refer to. And we will take a look. Let's see how it does open here. So we do not. So here is the link, revenue guide. And it should say that it partially updated August 21. Let's put it right here. Okay. So revenue from contracts with customers. Let's go back to my file. So definition of the revenue. We have discussed accrual basis of accounting a lot, and all these definitions apply to accrual basis of accounting. And basically now the revenue is defined as inflow or other enhancement of assets of an entity, or settlements of its liabilities, or a combination of both, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. So basically, when you establish a business, yeah, let me share the link to other means of communication. So I see that not everyone is engaged. So let's see. Okay, let's skip on email for now. Okay, let's come back to revenue. So basically, when you establish a business, you should probably already know what your principal activity will be. So that should be a for-profit business. Let's put aside governmental accounting and non-profit accounting. These are a bit different areas from the mainline accounting. And your business will generate revenue. It's supposed to generate revenue, and you might know what your principal and main activities should be. And when you perform those activities, you perform them for someone, for your clients, for your customers. And your customers, in most of the time, they will pay you cash. But sometimes you can provide them with services, and maybe you will get some services in return from them. Or maybe they will give you some other assets like vehicles. So if you sold your service for a vehicle, you will also have to recognize the revenue, and you will just, instead of debiting cash, you will debit a vehicle. So you will recognize the revenue on the vehicle. Let's make one example here. Where is my transaction list? Okay, so we sold services priced $10,000 for a vehicle with fair market fair value of $8,000. So for example, we rendered a services to someone, and that person said, okay, I do not have cash now, but I have a vehicle which I want to get rid of, and you actually needed a vehicle. So you agreed for that. You agreed for that deal. It's not the situation when you sold them for cash and they say, okay, I cannot pay, but I can settle it with vehicle. We just agreed straight in a straightforward transaction. We agreed, okay, we will do you that service, which usually So if we dig, I will not dig deep into it, into the treatment of that transaction right now. I might make a separate video about barter transactions, and it's covered in the revenue guide. Let's see. Okay, let's work in that one. So here it is. Here it is a definition. So that should explain you a bit what they meant by that revenue might be an inflow or other enhancements of assets of an entity or settlement of its liabilities. In a similar situation, when you exchange service for a service, you also want to recognize an expense. Unrelated to your kitchen, home, let's related to usage of your home, of your house for the business purposes. And let's say we do a service Give me a second. Okay, is there a sound now? Could you please tell me where we lost the sound? Could you please tell me where we lost the sound? Like at what point did we lose the sound? When we were discussing that transaction about okay, let me finish with I need to somehow see that. Okay, great. So we sold 5,000 worth of our personal services, of services of our business, and we exchanged it to the contractor to make some remodeling to our house bedroom. And that bedroom, it is not used in any way for your business. It's not your home office. You do not use it as a home office. And I first thought to pick a kitchen, but you also might use your kitchen for your business. And in that situation, it might be a bit complicated. If you buy some equipment to your kitchen, which you buy for the usage purely in your business, that will be a business expense. But now we have something else. We have a bedroom remodel, and it is completely irrelevant. So do you have any idea where we should book the debit of that transaction? So that's totally personal expense. Let me make a quick check here. I will give you a minute to think about it. Okay, so the answer is it should be owners. It should be owner's draw. Let me add a bit of size here. And owner's draw is an equity account. So basically we decrease our equity here. Respectively, there will be no cash implications from that. However, you will be taxed on that amount under both methods of accounting. So you will be taxed on that transaction as an income because it generated an income. Let's try to do that. Let's try to do that in the QuickBooks. Owner draw in the QuickBooks. Let's see what options do we have here. We have bank deposit, transfer, pay down credit, print checks. Okay, we can probably use print checks. No, that sounds complicated. Let me consult with a QuickBooks help for a second. Okay, QuickBooks says we have to do that through print checks standard. What? Okay, I don't like that option. Okay, maybe check. Okay. Owner's pay and personal expenses. And let's say we did 5,000. Okay, so we paid it. Let's save and close it. And let's see what happened in our reports with that transaction. So that's a purely balance sheet transaction. And here you see is reflected as an owner's draw, owner's pay and personal expenses. But we reflected just a draw side of that entry, and we entered it through cash. So we now need to enter the customer invoice. We enter the customer invoice. Let's say it was customer 1, and we also sold 5,000 to that customer. Let's see if we have services. Product service 1, 5,000. It is the best practice to reflect description here. I'm just skipping it during the lectures. We already let me just add another customer 2. Okay. Okay. So we reflected an invoice. Now it sits in accounts receivable with some negative prepayment from previous business which we had there, but here is the invoice. Let's see if we can pay it from here. Save and send, save and close, online payments. No, we don't have an option to pay it here, but we can pay it through receive payment. Choose a customer 2, invoice 2, payment 5,000. Save and close. So with that, several transactions we generated 5,000 revenue in our business, and we make an owner's draw. We withdraw money from the business. So that's an interesting one. It's still an exchange of services, and you still have to recognize the revenue even if you do such a transaction. And that's kind of a requirement of accounting standards, and it's a requirement of IRS to record these revenues. So they want you to record all barter transactions which you engage in. Of course, many people do not do that, and if you make a birthday cake for your friend and then they make you some service in return, no one reflects that ever. But if you run a business and if you want to comply with all the requirements, you probably have to start doing that. Okay, now so we discussed how do we understand when we generate a revenue. So it should be some main activity of your business which produces income for your business, and it should generate you cash or some other assets, or some can settle some liabilities for you. I will not show an extra example for a liability, but assume you owe someone for something, and you say, okay, I cannot pay you, let me do you some service. And assuming the other party agrees, you can render your services to them and they will write your debt off, and you will have some contract about that, and that will also be a revenue generating activity. And now we have a quite complicated topic related to revenue recognition. Now all that guidance it's built, it tries to show you a general principle or how to include all possible revenue generating activities into one framework. Most of the time we deal with pretty straightforward issues. So first they say that you actually need to recognize revenue in 5-step framework. So you kind of identify your contract, your obligations related to that revenue. You might be making your contracts with customers, but it also might be all like oral, not written contract, or it might be customer business practice in your business that you, for example, if you run just a shop, you just get cash from your customers and you issue them a receipt, and that's all you do. That also constitutes a contract with customers. Then you need to determine what are your obligations per that contract. That model is built for a complex contracts. Like you can have one contract that say a customer should pay me $100,000 for that piece of equipment, for 10-year warranty on that, for service, 10-year of free service and free spare parts for that piece of equipment. Now, when you sell actually the equipment to your customer, you do not just sell an equipment, you sell a lot of different services, warranty, support, spare parts possibly, and that framework says that you need to allocate, you need to identify what your obligations are under the contract, and you need to allocate your contract total to different pieces of the contract. So you need to determine the transaction, determine the price of the contract, allocate that price of the contract, and then you will recognize the revenue ratably over time, depending on when you kind of perform on these obligations. So for example, if you sold an equipment with all that stuff, with warranty and support and spare parts, you will recognize you allocated the price of the contract to equipment, probably the most of the price, and you recognize the revenue from that when you actually sold the equipment, when you delivered the equipment, when you performed on that obligation to deliver the equipment. Now the warranty part and support part, since that is a service which is spread over 10 years, most likely you will be recognizing the revenue of the which you allocated from the 100,000. Let's assume you allocated $80,000 for equipment and $20,000 for services over a 10-year period. In that case, you will recognize revenue when you deliver an equipment, and you will recognize services when you over the 10-year period. You will recognize remaining 20,000 over 10-year period. But most of the time, when we just sell a single product or when we just render a single service, and if it's a separate contract for each, we just do recognize sale of products when we transfer the title of the products, and we do recognize sale of services when we actually render the services. But you need to look that your contract reflects that, your contract or your customary business practice. So that's just a general wording that in the standard describes principles that we need to apply to the revenue recognition. And the core principle requires a reporting entity to recognize revenue. Let me make it bigger here. To depict the transfer or goods or services to customers in an amount that reflects the consideration that it expects to be entitled to in exchange for those goods and services. So basically it says that the numbers which you put in your financial statements in respect of your revenue should depict the transfer of goods or services to customer. So basically, if you haven't transferred your goods and services to customers yet, you shouldn't recognize the revenue. Or if you are in the middle of transferring the services to a customer, you rendered half of the services, and you need to record something in your financial, you most likely need to record the first half of that services. And if it's a product, if you transfer a product, it's usually when you deliver, when the title passes to the customer, when customers become the owner of that product. Like if you delivered, I don't know, a cake or some apparel or some, if you're a car dealer, you sold a car. Some more complicated might be like a construction services. When you construct some complex product for a company, you might be able to recognize your revenue ratably based on that contract. But that's an advanced accounting again. Okay. Certain criteria must be met for a contract to be accounted for using a 5-step model in the revenue standard. A reporting entity must assess, for example, whether it is probable it will collect the amounts it will be entitled to before the guidance in the revenue. So basically, when you do a revenue, when you sell something to your vendor, you need to make an assessment whether you are going to collect a revenue from that customer. And if it's not probable, and probable is like a 20% rule, 80% rule. So if you believe that the chances of collection are less than 80%, you will need to recognize, let's see here, collectibility threshold. Probable is defined under US GAAP as likely to occur, which is generally considered 75-80% threshold. In IFRS, in International Financial Reporting Standards, it's only 50%. So you need to be sure, like 80% certain, that you will collect money. You will collect. Let's make a step back. So we discussed what the transfer of services, how it looks like. And we also need to discuss the other part. We need to discuss the amount which reflects the consideration that you expect to get. And consideration is what you get from your customer. Let's go back to that situation. We sold services which we usually price for 10,000 for a vehicle with a fair value of 8,000. So that 8,000 is your consideration. So that's your consideration. And if it's valued at 8,000, you have to recognize 8,000. That's that's for the Z part in an amount that reflects the consideration that it expects to be entitled to. And further, we have a discussion that a contract contains a promise to transfer goods or services to a customer. In a simple contract, you will have only one promise. If it gets complicated, you will probably have to go through all these 5-step models. So in a simple contract, that will be one promise, deliver a product, render a services, and it will be say for your consideration is the other party will pay you that amount for that product and services. If it gets more complicated, you need to go and research revenue guidance. It's 250 pages, not easy to research, but most of it relates to pretty complicated transactions. And we are just considering some simple transactions here. If you have a thoughts about any transaction, please send it, and we can look how it can be treated under that revenue guidance. Okay. So they say that identifying revenue obligations can be relatively straightforward, or like selling a television by a store, but it can also be more complex, such as a contract to provide new computer system with a 3-year software license, a right to upgrades, and technical support. With that, so that was a modern accounting guidance. Now let's go to our MIT lectures. Let's see what we have in MIT lectures in that respect. So that will be lecture 6, revenue recognition. I will share it with you. Please note revenue in MIT. A revenue guidance in MIT lectures is outdated, but it is still interesting to look into that revenue guidance to understand how has it evolved over time. Let's see here. So revenue has a big impact on bottom line and your profitability. That's, everyone knows that. Large sample evidence. Over 40% of SEC enforcement actions on accounting issues deal with revenue recognitions. So basically, if you might already know, there is a Securities and Exchange Commission in United States, and it enforces some issues with publicly listed companies. So when company is traded on a stock exchange, it reports its financial statements, and part of that financial statement is a revenue, and 40% of the issues SEC have with issuers of financial statements is about revenue recognition. That's basically the key issue. And they provide you with the old results with a Dow Jones Newswire section about different accounting issues. So Ceridian results to be restated. Restated means that a company issued a financial statements which were kind of materially incorrect, materially misstated. And someone, either auditors or SEC, or maybe company itself, they identify that they kind of did an error in financials, and they have to reissue financials. And when that happens, that's usually a big deal for the company. One of the recent stories was Luckin Coffee. Let's see. So there was a company called Luckin Coffee, and it was a Chinese company. And they did an IPO in United States, and everything was fine, and they have been growing. But at some point, I believe here some short seller reports came up. The share price dropped, but the market believed that it's kind of short sale, they are biased, nothing is bad here, so it even grow a bit after that, but then it dropped significantly from like 40 to 4. That's when the company itself recognized that its revenue was like hugely restated. So they basically printed like they tripled or quadrupled their revenue with the fake transactions. So they overstated massively their revenue. And that resulted in the listing, and the share price dropped to like $2 at some point. And the company is currently unlisted. So it trades as over the counter, so it's not listed, and it has that NCI at the end because it's not listed. So before the delisting it was LK. However, in today's market, it just grew from $1. What's the minimum? 52-week range, 360. But it was in 2020. It was at 138 at some point. So it has, from its lowest point, it has like a 10x growth up today. So company still exists. Let's see. They actually don't do like much losses. That's interesting. It still shows some numbers. The loss is massive, but still, someone still believes in that company, even despite all the fraud. It's like, okay, that people did some fraud, but we uncovered it, and now we believe they won't do that again because they were caught with the fraud. They actually, I think they probably replaced CEO, CFO, and probably several other people, but for me, it's not very. I wouldn't believe in the same company again if they do a fraud like that. But for some reason, market still believes in it. Okay, if you have any questions, send your questions now. We have 20 minutes more to go. Let's go back to MIT lectures. Okay, Tripos postpones earnings release, will revise revenue recognition policies. Opsware expects 100% revenue growth, points out transparent revenue recognition policies. Acco Corp faces class action lawsuit. So class action is when you are sued by your shareholders for some wrongdoings. Okay, criteria. Again, these criteria are outdated, and you need to refer to the modern revenue guidance, to the fresh, updated revenue guidance, which we covered in the first part of the lecture. So basically, 20 years ago, we recognized revenue when we performed all or substantial portion of the services to be provided. We incurred a substantial majority of the costs, and we received either cash, a receivable, or some other assets. So basically, that doesn't match with the current revenue guidance, but it kind of more or less corresponds to the new guidance. So we say that we basically performed the service, when we want to recognize the revenue. I don't think we tell anything about the costs, and we also say that we need to make sure that the consideration is collectible, that we will actually get consideration with like at least 80% probability, which is probably an equivalent of that requirement. Let's see, recognition criteria, accrual cash. That's what we discussed in the previous lectures. So basically, under cash basis, we recognize revenue when cash is received, and we recognize expense when cash is paid. Here in my homework file, I have that column for account, for cash accounting. Okay. That part. We recognize revenue when earned and realized, and we recognize expense when incurred. Again, we discussed a bit about that. Examples of revenue recognition events. These events, they do not change much in the new revenue guidance. So for example, title passes to the buyer and delivery takes place. So when we pass the title, we recognize the revenue. Reasonable estimate of uncollectibles, reasonable estimate of sales returns, reasonable estimation of all other material expenses. Most common in retail, wholesale, and manufacturing. So if you are in a reasonably simple business when you just sell stuff and you do not upsell any extra services to that stuff, then you just recognize the revenue when title passes. Bill and hold. There was a big issue with bill and hold transactions back in the day. It happens when you recognize the revenue while your products are still in your warehouse. So for example, they say that Sunbeam recorded 50 million in sales under an early buy program, and some were bill and hold sales and never even left Sunbeam's warehouses. So generally you shouldn't recognize a sale when you still have a control of the assets. Like for example, if that asset still sits in your warehouse and you didn't pass the title to the product to a customer. SAB 101, it was back in 2000. SAC has its own some of its own guidance related to the revenue, and it is mostly issued in response to different kinds of accounting frauds. And here's another interesting situation. Two fiber optic companies, probably internet companies, trade capacity worth of 10,000. So one company provided a piece of its capacity to the other company and vice versa. And basically they have to recognize the revenue in that transaction and cost of sales because they got a consideration back in return. Now the question might be whether it was like a legit transaction or was it like a fake transaction. If they just do that for blowing up, for increasing their revenues to generate revenues and kind of impress analytics and stock market, that's a fraud and they shouldn't have recognized it. But if they really do an exchange and they use that capacity, fiber optic capacity, it's a legit transaction because you provided a revenue and service. Let's go back here. You transferred goods or services to your customer. Yeah, they transferred the capacity and they received consideration. which is the capacity of the other service provider. So they basically got an inflow of assets, which was the capacity of the counterparty, and they delivered the services. So basically it was a pretty legit transaction. There was other examples of an accounting fraud related to revenue recognition. Like for example, Sunbeam sent more goods than had been ordered by customers. So basically, what a company can do at the year end, they just ship. So customer ordered 100 items and they shipped 120, and they reflected in their documentation that they shipped 120, and they do it right before year end, so that if auditors do an audit and they count an inventory, they will not see those items in the inventory. And Sunbeam pretended that these were the real sales. After the year end, when customers understand that they got more items that they needed, they will probably return those items. And that revenue shouldn't have been recognized, because it's not your performance obligation. So customers only asked you for 100 items. And if you shipped 120, that's your error. You need to recognize, you have no right to recognize the revenue from that. Okay, and there is one more example when Bristol Myers, the pharma company, inflated revenue by as much as 1 billion through use of sales incentives. So most likely they provided a very huge discounts to their customers, and that's helped them to boost their near-term sales by extending lower prices. So probably they were kind of shipping a lot of stuff to the customers and recognizing revenue based on the gross amount, based on the standard sales price. However, later they promised some incentive to the customer. So they basically returned like a half of the price to the customer back and reflected somewhere in the cost of sales. So that's resulted in a revenue overstatement. Okay, that's probably not relevant to us. It basically says when you in the past when we were able to recognize the revenue during production process. Like if you are constructing a ship for a defense contract, you will most likely recognize your revenue as long as construction goes, so on a ratable basis over the construction process. At some points it might be when you completed the production, like in agriculture. At some point it might be due to cash collection if you have any cash issues, but most of the time you will recognize it as long as you transfer the rights to products and services. Here is the importance of accounts receivable. So when you get the revenue, most of the time you get it as a receivable. For example, in eating places, receivable is only 1.6% of total assets. Because you come to the restaurant and you pay it immediately. You do not kind of say, okay, I will pay you later. Family clothing stores, racetrack, grocery stores. Yeah, in groceries you mostly pay on the place, either with credit card or with cash. Intel and semiconductors, 11%. Advertising agencies 40%, freight 40%, computer wholesale 40%, overall median 13%. So overall median says us that half of the businesses only have 13% of their assets in accounts receivable. But some businesses can be very heavy in accounts receivable. Now, what we do with accounts receivable? Let's say we sold 10,000 worth of microwaves and get 4,000 cash and 6,000 we don't get at the moment of sale, so we recognize the receivable here. Now, Sears knows that Sears don't even exist anymore, but back in the day they know that from credit sales, from accounts receivable sales, they record 5% as a provision for receivables. And that will be our debit bad debt expense, credit accounts receivable. That's a direct write-off. Net of allowance for doubtful accounts. Yeah, so we debit bad debts expense and recognize credit in the allowance. If you remember from earlier lessons, we have a debit credit tab here. We have a debit credit tab here, and we have that accounts allowance for doubtful accounts here. So basically it reduces your net accounts receivable. On your balance sheet you reflect net accounts receivable, and that account reduces your gross accounts receivable. And that's basically what we do here. If we recognize the revenue and then we realize that we will not collect the full amount of our receivables, we debit bad debt expense and credit accumulated depreciation. Okay. There is another situation. So that 300 was an estimate based on history, but we also learned that one of our customers goes bankrupt and he owes us $50. And we do that entry against our provision. So we basically totally write off these accounts receivable. There is also another method, and that's related to the estimate, how you do your estimate of uncollectible accounts receivable. And basically you do that by looking at the history. You can estimate based on the history of payments. You can make an estimate of your uncollectible debts. For example, if some balance is only 30 days old, the chance that it will not be collected is just 0.8%. And if it's more than a year old, you kind of expect 50% not to be collected. And based on that, you can make an estimate that your total uncollectible expected is 34,000. Okay. And basically here you can do that based on the self-study. You can look how one can estimate the provision for their accounts receivable. We will do something in the practice around that. And that's pretty much concludes today's lecture. So basically what we covered revenue recognition principles. We looked at the guidance. We found the guidance where we can find most updated revenue guidance. We looked at several transactions which can cover the different aspects of revenue recognition, like whether you received cash or you receive other form of assets for your revenue, or you settle liability with your revenue. Then we went through the MIT lectures on revenue recognition. We covered possible instances of fraud in revenue recognition, and we discussed that the lectures are kind of outdated in respect of revenue. And we cover accounts receivable and what we do with accounts receivable if we have an estimate of accounts receivable not being collected. With that, I conclude that lecture. Let me share a link with you on the next lecture. Let's see where it is. Okay, on the next lecture, we will go into accruals and T accounts. It will start in several minutes. So let's see each other on the new lecture.